Hello, I'm Juliette Sarli. In this week's edition of IG Macro Intelligence, we take a look at the recent efforts by Chinese authorities to stimulate their economy and Australian stocks which may benefit. Chinese authorities have announced new stimulus measures in their bid to bolster activity in the world's #2 economy. Their hope is the economy will grow by 5% in 2024, a target that was looking increasingly unlikely before the latest stimulus measures were announced, especially amidst the ongoing property crisis. China now plans to, quote, significantly increase government debt issuance to provide subsidies for low-income individuals, support the property market and also bolster state banks' capital, all aimed at revitalising its struggling economic growth. Following the latest round of stimulus measures, Goldman Sachs is bullish on 2025 growth in China, tipping GDP to increase by 4.7%, up for an earlier prediction of 4.3%, and they expect the Chinese economy to grow 4.9% this year. More stimulus could be on its way. The National People's Congress meets later in October. The upcoming policy briefing overseeing the country's budget, and last October, the Standing Committee of the NPC approved extra sovereign debt and increased the budget deficit ratio. Analysts say it's likely there will continue to be a drip feed of support until the year end. September's stimulus announcement was met with a stock market rally, which then faded amid scepticism that the policy measures wouldn't be enough. On Monday, after the latest round of stimulus, the CSI 300 rebounded from its worst week since late July. Goldman Sachs has upgraded their recommendation to overweight on Chinese shares, tipping a further rally of 20% if authorities deliver on their promises. Raymond Chan from Morgans is among those who expect more piecemeal announcements from authorities towards the end of the year, telling Aussie one of the best ways to play the thematic in the Aussie market is through the miners.
And to me, is the resources stocks that I think start to see a little bit of support. Yes, there's some media suggestion that the Chinese stimulus is not big enough, but my feedback, I got from my contact is they're likely to be more measure, more policy, all the way toward the end of the calendar year. So I think resources stocks at the moment are trading at undemanding multiples at the moment. This is, where I would see a lot of opportunities.
John Mills from Morningstar told Ausbiz the short-term demand for commodity-related stocks like BHP and Rio Tinto look good. ASX TradeWatch data show BHP shares are in a medium-term rally, with the 5-day moving average above the 50-day moving average and the 20-day moving average on the rise. The average target price for BHP is $45.91, with most analysts recommending you buy the stock at current levels. When we look at Rio Tinto, it's underperformed BHP shares slightly in the past month and by 5% year to date. Shares are in a near-term rally within a longer-term bearish trend, suggesting limited demand from investors for the stock. Rio's recent acquisition of Arcadium Lithium, though, puts it in good stead as a diversified player, with the miner set to become one of the top 3 lithium producers in the world. When it comes to Treasury wine estate, that could be another way to play the China trade, according to analysts. Amid the lifting of trade barriers by China, sales of its flagship Penfolds brand have surged in the world's second biggest economy. However, in June, the company's CEO Tim Ford told investors it would take until 2027 for Treasury wine to rebuild its China business and return to the kind of profits it had experienced before the imposition of tariffs. Shares are in a long-term bullish trend, and the average recommendation, according to Refinitiv on Treasury wine estates, is a buy. And that is your IG Macro Intelligence for this week. We'll see you next week.